Hello traders, welcome back to the show. Hey, before we get into it today, a little bit of sad news. The Algorithmic Advantage is for now losing its esteemed co-host, Rich Brennan. Rich, sad to see you go.
Thanks very much, Simon. And it's sad to leave. I've had a blast on the Algo Advantage and I've loved all of the interviews we've done with
It's been great.
Great traders, fantastic. And I want to thank the listeners as well. And mate, I found that I was a bit spread too thin.
You're a very busy man.
Yeah, need to focus on my netting of outlier hunting. So that's where I'm going to be redirecting my focus back to. So I don't think it's saying goodbye forever. So hopefully I'll pop in again and catch up with you all. So looking forward to it. But
100%. Look forward to checking in, getting you on the show from time to time. I know you're extremely busy, so it's been great to have you while we could. And we will chat very soon, no doubt. And the ghost of Rich will be ever present in the background. You've transformed my view of trading, which is great, and given me a lot to chew on over the time here, and changed some of the things that I do, which is good. So yeah, I'm sure we'll be checking in down the track.
Many thanks, Simon.
Okay, mate. All the best.
Bye-bye.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Right, today I have the great pleasure of finally getting PJ Sutherland from Sutherland Capital Management on the show. I consider PJ a friend and a trading mentor. He's shaped a lot of what I do over the years. Like myself, PJ surfs, so we're looking forward to surfing our favourite Indonesian island sometime soon, PJ. But for now, let's talk trading. Welcome to the show, finally. I get you on.
Thank you, Simon. It's a pleasure to be here. And I look forward to that surf one day in Indonesia. And in fact, when you think about surfing, one can draw many analogies with trading. And perhaps that's why we ended up both surfing and trading. So I look forward to that surf one day.
Indeed, man. I can't wait. So listen, I'd call you a short-term equities trading specialist. You trade short-term mean reversion, short-term trend following strategies on US liquid stocks. I can't wait to get into all of that. But let's start with a quick background. You know, how did you get into trading, and then I guess into quant trading specifically?
Sure. So I've been active in the markets probably 20 years now. And prior to the markets, I was involved in property, and I owned a little business that had done fairly decently. So I had some excess cash I was looking to invest. And one natural destination are the financial markets. And so I considered that, and I like to do things on my own. So I opened an account, learned that one could apply leverage, went in guns blazing, and very quickly lost an account. And ironically, instead of determining that leverage may well be the cause, I thought, let me just change methodology and perhaps increase leverage. So I went on to lose another account, which then forced me to pause and reflect on this journey. And I have it, I guess one of my strong points as a person is I have quite a lot of tenacity. So it didn't deter me. And anyway, that sent me on a path where I guess what many people do is you kind of go out to read a lot of books. I attended a lot of seminars. So some of the names back then, you know, you would remember John Bollinger, Chuck LeBeau, Larry Williams, Van Tharp, managed to pick their brains. And this went on for sort of several years. But really, I didn't find much success. So this certainly wasn't going to be a straight path to heaven journey for me. And after kind of being flat and sort of losing money through those years, I had to sort of sit down, confront myself. But, you know, it was kind of a critical base. I don't think it's possible personally to go on and succeed without experiencing some of those troubles early on. And at the end of all of that, you know, I came to some conclusions. First, I was just never going to be a subjective trader. You know, I was just way too emotional. And then that kind of led me into being drawn to short-term trading. So I had the privilege, of course, of trying many different models through that period. So I had longer-term models, shorter-term, mean reversion, trend following. And I was really drawn to the short-term because I could see the emotion in the financial markets. And that kind of really was the primary cause of all my losses. And I believe that if one could kind of, bet against that there's potential to gain. And I guess philosophically on a high level, to be successful, one wants to sort of increase their opportunity rate. And if you're doing 50 trades a month and you're struggling, at least you can refine your approach and try the next month, as opposed to someone, for example, doing 5 trades a year. And so I knew I needed to enhance my skill sets. I really wanted to mechanize things, start to base decisions on data. And at that point, I kind of maxed out on the retail platforms. There were platforms out there like Metastock and TradeStation. You kind of reach a limit of what you can do. So I sort of resolved to go on and do some studies. So I did a BSc in computer science to enhance that skill set. I was also drawn to the technical side of things. So I started and completed the Chartered Market Technician program that I found really interesting. Exposed me to ideas from behavioral finance that really confirmed this idea of emotion in the marketplace. And then I wanted to expose myself to the fundamental aspects. So I started and completed the CFA level 1. I never ended up pursuing that through to the end because it really wasn't relevant to short-term trading. But what was interesting in the CMT, that kind of briefly exposed us to the efficient market hypothesis. But in the CFA, they really kind of drummed it into on level 1. And as someone that had been through this journey now, losing money and, studying, you're kind of being told that you can't make money at this game. Mm-hmm. So that was a little depressing, but it was also the impetus. Of course, I knew there were firms like Renaissance, there were Warren Buffett. So clearly this wasn't entirely true. And that kind of sent me on my own search to disprove that. And there are many ways you can do this statistically, but one of the ones I sort of favor that nicely illustrates that prices aren't always random is to study their distributions. So I looked at price returns in the short term. I started in South Africa where I was based, and I sort of expanded around the world. And I learned that actually price returns, despite resembling randomness, largely normal distributions, have 2 key differences. They have a more peakness in the center, and they have a fatter tail. So Leptokurtic distribution, they have a kurtosis higher than 3. And what that essentially means is that you get this sort of oscillation around the mean, which may suggest mean reversion in the short term. And their returns farther from the mean that suggest every so often their trends. And so finally, I'd kind of proven statistically that these edges exist in the market. And really, it kind of confirmed what technical analysts, the Market Technicians Association, had been doing for 100 years. So that was exciting. And that kind of led me into the next stage, which was then to start building a more quantified approach. And that took time. But eventually, I started to see some success in my trading. And off the back of that, I launched Sutherland Research, which ended up being a quantitative firm, which became a regulated financial services firm in South Africa and Mauritius. And there I exposed clients, typically sort of high net worth clients, hedge funds and family offices, to my ideas. So I essentially ran managed accounts for around 7 years there and had a great year, my best year in 2020. And at that point, I'd finally sort of gathered enough assets and clients to go out and launch my own private fund, which I run up to this point.
Right. So we know that, you do both mean reversion and short-term trend. So let's sort of work through that in order, I guess, if we might. We've done a lot of trend following stuff on this show, so it's time to talk a little bit about mean reversion, but obviously also we're very familiar with the risks of mean reversion. So let's talk about how you've tackled that and why your strategies work and when and how they handle different regimes and so on. So I guess just starting at the basics, talk us up through the basics of the key concepts in building a mean reversion strategy.
So, I think just taking a step back, Simon, there's some key sort of elements that drew me into it. And, when I kind of looked at those Leptokurtic distributions, I could see there were trends in this mean reversion. And in theory, back then, I sort of envisaged that being the holy grail. The truth is trend following models are way more difficult to develop in the short term for many reasons, which we can touch on later. So I was kind of drawn to the mean reversion world. And so if you think of mean reversion quite simply, if you deconstruct the term, there's a mean involved and then there's a reversion. So really what you're looking for is for price to pull away from some predefined mean. And then you take a position sort of counter that in the hope that it reverses. And early on in my trading, and I think back in time, you really could do okay with simplistic models. I sort of had kind of one parameter models. So you'd take a moving average and you could use any number of, whether it's a standard deviation or a unit of average true range or just a percent factor, but something that at least displays there's some sort of stretched condition in there. You test that and you take a position counter that, and then you get the mean reversion back to the moving average and you exit. That now is not really the case. So, when through time that kind of worked, but I started to see a lot of discrepancies between my live and backtested trading. And what I learned from that process is that if you think about mean reversion, at the start of a trade, you really don't know where the reversion is going to start. No one does. And on the opposite end of that, you also don't know where the reversion will end. And so going on and building a model that literally just latches onto any number of parameters within that spectrum is relying on a lot of luck. So that kind of led me toward this idea of diversifying across what I call the mean reversion curve. So instead of relying on a single parameter, you're starting to build allocation as the move continues, and you start to unwind it as it moves back to the mean. So you could think of that as going, well, let's put a little bit of exposure on at 0.25 standard deviations, 0.5, 1, etc., and you'll have some sort of bound on that. And once I started to do that, you start largely to remove the effects of luck. And there's a lot of luck in financial markets, which perhaps professionals don't like to pass on. And that really started to get us closer to more consistent performance. But of course, there are risks in there, which we can talk about in a moment, that can lead that astray.
So that's a key part, isn't it, of the mean reversion trading? Then it's not just a strategy; it has to be a portfolio. So you start to diversify across that mean reversion curve. You're effectively, I guess, averaging in, averaging out, taking smaller chips at chipping away at the market as it comes down and bounces back. So I guess tell us a bit about the nature of putting together that whole portfolio. Like, and does that require just an enormous account balance? Can you do that on a smaller portfolio? How diversified can one get?
Sure. So this is the difficulty nowadays that we face. I believe, and it's not dissimilar to the turtles that everyone's very aware of, where they use kind of simplistic one-parameter models and went on to make a lot of money. Mean reversion was very similar in the past. You could literally go in and do that. The world has changed now. Of course, there's a lot more competition in the game and a lot of people trying to do the same thing. So it does become a lot more difficult for a small account to go out and effectively capture mean reversion without reducing the effects of luck and being exposed to tail risk and things like that. The other problem is, which is challenging, although perhaps nowadays with the likes of AmiBroke and some of the other platforms out there, is the processing becomes more extreme. So you could end up, if you're iterating across your entries, so let's imagine you've got 7 entries, as the stock sells off, or think about the long side, you're systematically entering on the way down, and you have 7 exits as it starts to recover, you're systematically exiting on the way up. You've already got 7 by 7, which is 49 permutations, but you also want some diversification in your setup. So you can see how very quickly this is exponential in nature. It sort of explodes. And of course, you can't trade the world's parameter set, but you really do need to try your best to capture as much of it as you can. Now, for smaller accounts, luckily we're in a world now where comms are a lot lower. Some brokers don't have minimum commissions, so that's kind of critical. If you can access a broker that doesn't apply a minimum commission, then you can get away with sending one share, literally. So you could take an order of 50 shares and cut it up into 50 chunks. It's a lot more processing, of course, and you need your execution engine needs to be pretty quick. But I think once you get to that point, you get much closer to what I would call a full solution as it relates to mean reversion.
So again, just covering off the basics before we talk about the inherent risks in mean reversion and how you deal with that. I mean, why include mean reversion at all?
So if you look, studying the Leptokurtic distributions, for example, the more prominent occurrence or tendency in the market is mean reversion. So that happens far more frequently in the marketplace. Trends are actually the exception rather than the norm. So immediately, straight off the bat, you're dealing in a world where there's a lot of opportunity, and that does sort of lead into being making it a little easier to develop models that can capture the edge. So that's one thing. The other is because you're essentially taking a profit, so you're convergent in nature, you tend to see much higher win rates. And of course, we know mean reversion will struggle through regime change. It faces risk just as any other model. But largely, markets kind of get into a regime and then stabilize in that regime. And in that environment, mean reversion can deliver really very consistent, pleasing performance. So it's not impossible to see sharp ratios above 3 during the good times, 90% monthly winning rates, 70% trade winning rates. And so that is appealing if you're able to capture that while intelligently offsetting the known risks of mean reversion. Then essentially you have a sort of compounding engine, which, as Einstein's referred to as the greatest force in the universe. So these little profits start to mount up and can mount up very quickly if you do it well.
You've got a lot of trading happening too, so that compounding can happen all the more quickly, can't it? When you've got a lot more trades to test over.
That's exactly right. Happening. In fact, if you look at any sort of return profile from any model, it's incredible, and especially if it's kind of non-correlated to mean reversion, it's incredible what just tiny returns every day, if you kind of add it into the new model, what they can lead to at the end of the year. It's really material. And that's one of the things I love about it, is you can kind of lock it into another strategy and just enhance performance significantly across the board.
You get a feel for, what the sort of expected outputs are too, I guess, where you've got that high trade frequency. When you're trading long-term trend-following models, there's not that many trades taking place. So if you, play that out under a slightly different regime, a different environment, you miss a trade here, a trade there, your results can look dramatically different. If you start a backtest at one period versus another, because there's not that much activity going on year by year. So I guess with the mean reversion, you can sort of really get a handle on exactly what's taking place day by day, and your expectations, if all things remain the same, can be a little clearer.
I entirely agree with you, Simon. That's one of the big problems, and I've played a lot with longer term models, is I think when you move from the short term to the longer term, you really start to lean much more on your thesis, and it becomes less data driven. Your samples are small. Remember, we're dealing in a world that's non-normal. So you can't use normal statistics, things like standard deviations, and you only need 30, a sample of 30 to, that all falls by the wayside. You really need big data. And so when you go into live from longer term models, whether they're 20-day, 30-day, 50-day, the discrepancies between what you observe with your backtest, I think, can be extreme. And the tendency toward overfitting increases significantly. So, we have this law in statistics called the law of large numbers. And in trading, you need many more than they'll lead you to believe, of course, because non-normal. But I think you do get closer to this idea that if you have enough of it, you almost don't even care about the thesis. It's just the probability of this thing happening purely by chance is basically zero, if you're doing 1 million trades a day. And that I really liked. And I mean, there are different approaches, but I do think one thinks of trend following is the big part of that is the thesis, that there are these dislocations every so often in the market. And you really need to lean into that because you can see really long periods of time with losses, differences between backtests. And where in the short term, we've got the thesis, but I do like the idea of having a lot of data. It can be misleading, which we can talk about in a minute, but it definitely does play more into a data-driven approach.
Yeah, 100%. All right, well, let's get into that. So let's talk about some of the more advanced concepts in mean reversion. So the newbie trader will happen upon a nice mean reversion backtest that will produce this incredible 45-degree equity curve, and they'll think they've found the holy grail. What are some of the deeper issues when we start thinking about correlations, negative skew, the fact that trades aren't necessarily independent bets, the fact that the future is still very much unknown. We don't know what the next event is going to look like. How do these things play out in the risks of mean reversion?
Yeah, so I think in my early days, I'm grateful to still be here. And I guess any trader, as you move through your journey, you learn about your strategy. But one of the things certainly early on, I think, if I look back in time, I was almost delusional in, the back test I could generate. You could make these equity curves look like, rocket ships from bottom left to bottom right, and what actually happened in life. And there's there's a reason for that now. And initially, it wasn't completely crazy. I'd done a lot of studies. I've done a lot of statistics, and you do have this thing called the law of large numbers, and I really leaned into that. So, I built models that trade, for example, the top 1,000 equities in the US, and can hold 50 positions and are doing lots and lots of trades over extended periods of different regimes. These are different stocks, and you get these great-looking equity curves, and you step away and go, "Wow, this is the law of large numbers. This thing's just going to work." And then you move forward in time, and you get some unpleasant surprises, and that happened more often than I'd like to admit. And so I really needed to go back to the drawing board and understand what is going on here, because you can't clearly rely on this idea of large numbers. So if you kind of deconstruct that, when mean reversion's kind of in its stable regime, you tend to put on these bets that are more independent in nature and are less correlated to one another, and everything works really well. And the difficulty here, that kind of happens more often than not. It's the events where you kind of shift regime. And here I'm talking about a classic example is the COVID pandemic. You think about volatility days before it started and after, so your models are now fully adapted to this kind of low vol regime. And then you have this big tail risk event that enters the market. And suddenly everything goes correlation 1. And so what's happened is your assumption, the law of large numbers now completely falls away. Every single stock is moving down. All you're doing is making a big bet essentially on one stock. And that is called tail risk. And this is a risk that is deadly to mean reversion traders. And we can talk about ways to cushion it. Clearly you can, we've been around. But it is something that I didn't fully grasp early on in my career. I kept building models with lots of trades and then experiencing these events that come in and completely change the performance. So that is a very careful, I think, consideration that new traders need to be really aware of. And the problem with it, Simon, is that these tend to be, by their nature, infrequent. So if you've studied the market long enough, as you and I have, especially as mean reversion traders, you can kind of roll them off your tongue. We had the pandemic tail event at end of 2018. Then it was one. We got August 2011. You had financial.com, but the big one, it was 1987, where things just went straight down. And I can tell you, if you model your models through that and you're honest with yourself, it's almost impossible to build a model that doesn't see 50% drawdown in a short space of time there. So you've got a very small sample, call it 20 type events on the tail end, and that's just not enough. And they all look different, So when you build your model, you have this kind of tendency towards survivorship bias. And what I mean by that is you're kind of iterating through mean reversion models, and eventually you lock onto one that's literally just sidestepped all the landmines.
Sidestepped all of those, yeah.
Exactly, yeah. And then you feel super confident, as I did. I mean, I would have sold, my mum for, I've got big numbers, look at this, we're doing 1,000 trades a month. And then these things appear, and it's like, wow, everything goes down at the same time. And that's a risk one needs to be aware of. And then we can talk about in a minute how best to sort of cushion against that. I believe there are techniques that will help you survive, but one does need to be aware that drawdown profiles and good-looking equity curves will disappoint at some future point specific to mean reversion.
Yeah, let's get into how we deal with that, because, you and I, PJ, actually we were very well prepared for the March 2020 COVID tail event. I know that we both had a fantastic year and a good month. So there are ways, I guess it's like you were talking about with trend following, you've got to rely on your thesis. If there's only so many tail events in your history in a backtest, the newbie backtester is going to quickly sidestep those landmines. But you have to be a lot more honest with yourself, honest with the limited amount of data, and I suppose start to develop a thesis about, just the reality of this kind of model. Rich would call it warehousing risk. These strategies tend to warehouse risk. So you're putting that risk in the warehouse day by day until one day, boom, the floodgates open. So if you're aware of that, and you know that can happen, you know that you don't have enough data, but you know that it's a very real possibility because we're trading in stocks, these bets that are no longer independent. Correlation of all stocks can go to 1, so now our whole portfolio is in a single position. What are some of the ways that we can manage that. And you haven't mentioned shorting yet, so let's add that in there and when it works and when it doesn't on the mean reversion side, and then we'll move forward to your more complete, I guess, portfolio response.
Sure. So, I think for a noob, really selecting your universe is crucial. So, if you really want to protect from that, an easy way to do that is start with a sort of basket of country ETFs, where each ETF is well diversified. The probability of going to zero is, almost zero, although it can happen, but very, very rare. And if you test that, that's true. The tendency for mean reversion is unreal in ETFs. Of course, returns are muted, etc. When you step into the world of stocks, I was reading interesting bit of research the other day that the most repeating return in stocks is zero. So stocks tend to go to zero. So it's a very small group of stocks that kind of drive the indices and things. So when you consider that and where that tends to happen is usually the kind of mid cap, small cap space, and less so prevalent in the larger cap space. So if you so that's critical universe selection. That bears itself in the data. If you go and try and trade small cap counters, that the tells are extreme and you need to be, I think probably going to be taken out at some future point. So universe selection, you want to look at counters that are big. These are typically, let's imagine the S&P 500 stocks. They have lots of different investors that are participating in them. You can have short-term guys, longer-term guys, and that's almost guarantees, and they're far more regulated, almost guarantees a sort of volatility on the way down. Of course, they can see trends to the downside, and that's crucial. Having said that, these can also go to zero. So your ultimate form of sort of risk control is position sizing. So you got to choose your universe, and then you need to say, all right, I'm fully loaded in the market and we have this big event. And then you need to run sort of scenario analysis of what you can sustain, how much leverage you can put on. That's really, really, really crucial. And then your position size, individual counters when they go to zero. My sort of working hypothesis up to the Signature Bank crisis was a big liquid 500 company won't go to zero in a day. And I was caught in that stock, so it can happen. But, the month was only down 3% because we correctly position sized ourselves. So that's crucial. Risk management, universe selection. The next this is where diversification really comes into play. So if you're just going to have one entry and one exit, you could easily miss the volatility on the way down. So I'm talking about, long trade that's working against you. If you have, 20 entries and 20 exits, then the probability of capturing some of those exits on the way down or missing some of the entries as the entry unfolds is much higher. And so these models are, in fact, any model, it's incredible. They're really sensitive to price movement. And there's a lot of luck. If you're testing a one parameter system, you may find the trade that completely blows up occurs 1 penny below your entry price that you missed, etc. So you want to have the universe in order, and then you definitely want to look at ways of diversifying and controlling risk on position size and at the portfolio level. Then, of course, you can kind of zero into those pockets and potentially overlay throttles. So how many orders are you willing to send on a single day? Does it make sense to send all orders if you've got 50? Or should we release them into the market, in batches of 10 across 5 days? That's really sensible because the big events are going to unfold over days, so you don't want to kind of be caught early on. And then the other interesting ways, of course, you could diversify across sectors, et cetera. But the key is sort of diversification across your entries, your exits, your universe, and then perhaps kind of throttling the way you would enter that type of environment.
What role does having short mean reversion strategies play?
So the shorts in general are challenging. And they're challenging because economies tend to expand and markets tend to rise. Having said that, so you kind of see a lot more consistent losses in there. I do, however, find that the extreme losses come on the long end, and that's kind of proven out in things like prospect theory from the world of behavioral finance, where Daniel Kahneman won a Nobel Prize for his work there, where he's proven that a dollar loss has twice the effect on us as a dollar gain. So fear is a way more potent emotion. People don't believe that, because you can have these single stocks that go up, 100, 200. But largely, when you test our mean reversion, you're going to see the extreme events, if you have enough data and enough tail events, occur actually on the long end. So you can kind of build these models and deploy them, and then just expect that they're going to be challenging, but where their contribution becomes absolutely incredible and meaningful is when you do see the bear markets. And so my belief is that the best way to diversify any portfolio is to include shorts. And of course, you can decide to not allocate 100% to them if psychologically you can't sustain the losses that tend to occur more frequently in bull markets. But then, of course, you won't make that up as much in the bear market. So I tend to equally allocate to both of them, and then ensure you're getting enough counters in there, small enough positions, etc., etc.
Of course, the modern day 1987 for shorting, I think, is in this kind of strategy is probably the 2021 meme stock blow up, right? And you had stocks that gapped up overnight like 400%.
Sure.
What are some of the lessons learned from the meme stock frenzy?
So some of those, and those are dangerous. Again, if you're looking at the larger cap stocks that belong to the indices, you tend to avoid those. But you have to accept that at one point or another, you may well be exposed to that type of event. And what's really critical, if you study all of those events, they all revert. They revert in a very large way. What's critical is not being shaken out of the trade. So this again falls back on how do you size yourself. And this is really, really important. You need to build position sizing algorithms that don't just deploy static sizes. They really need to consider the nature of volatility in the stock you're trading. And that doesn't just mean looking 10 days back. That's looking at the stock holistically and saying, has this thing blown up in the past, etc. And then you need to size around that. So you can spend a lot of time in position sizing, and that's really kind of critical to offset that. So, for example, the sizing algorithms I use, I think the position sizes were so marginal, the ones I use today, because those are, of course, encounters that one needs to consider and analyze. I think they were sort of 0.2%, thereabout, with the option to be at 5%, so the vol-based position sizing really kind of forced them down into insignificance. But focusing on the big cap guys, vol-based position sizing, accepting, perhaps reducing risk on the short side if that scares you, accepting you could have something go 100 to 200%, but then making sure you can see your way through it, because largely if you analyze those, there was some very big potential for return. Not entering everything on the same day, 2-3 days spread apart, so you're capturing the exposure as you go up. These are all useful ways to do it. And then ensuring, trend is a function of time. And the thing that kills mean reversion is trend, So making sure that your average holds, I think in all my models, are probably 1.3 days, thereabouts. So you need exits that are at least some exits are sitting super close to the market. So any type of volatility down will unwind some of your exposure. So you really need to think about that quite carefully. If you do it well, it's feasible that you'll navigate those.
So you've moved everything over to this to volatility-based position sizing. What were some of the reasons for that?
Yeah, so I think I did for years trade purely static-based position sizing, where you're just taking a percentage basically of your equity and dividing by the stock price. And I think that can be misleading, and largely because a lot of the risk in mean reversion is to the downside, and 9 times out of 10 it reverts. It's the one time it doesn't that we all need to be concerned with. So again, you kind of enter this world of potential delusion, if you're making these bets. And what happens is, if you're not using a vol-based position size, often if you can't, test it alongside vol-based, the static gives a better outcome. And that's often just because the 9 out of 10 times is working and you're putting on a greater position at the bottom, where vol-based is systematically kind of reducing it. So in theory, when you think of it like that, that kind of makes sense. It doesn't always show up in the backtest. When you start to extend your backtest over significant time periods, and here I'm talking including 1987, so 40 years worth of backtesting across enough counters, you'll find then that the comparisons are actually very clear. Vol-based position sizing wins every time on the risk front, and that's intuitive. If you're going to expose yourself to a stock that can go up 400 times, 400%, 4 times rather, and you're putting on 5%, well, you've got a 20%, drawdown there, which to some might be tolerable until you realize there could be two other stocks doing the same thing. So that leads you then to blow up. So yeah, I think those are all ways that one can resolve that.
Just one thing that occurs to me to just mention to the listener and viewer as well, obviously, is that short mean reversion trading is not necessarily the hedge for long mean reversion trading. Do you want to just give a little bit of an insight into why that is the case?
Sure. So mean reversion by nature is very directional. So when you build your long position, the market, especially when you put on the bulk of your exposure, you tend to find that the market starts moving towards a correlation of one, not necessarily there, but it becomes more correlated because fear is so powerful, so you have all this indiscriminate selling. While that's happening, any short exposure you have on is being unwound. And so once that sort of plays out in full, you end up in a position where you basically just long the market with no short exposure. And the opposite holds. And that actually is a challenge worth talking about when it comes to mean reversion, because yes, I was drawn to it initially psychologically. It's rewarding, high win rates, high monthly win rates, really consistent performance and good regimes. But when you encounter those episodes that don't happen frequent, it's kind of 10 years of calm and a day of panic type thing. You end up with a situation where you're loading up on exposure and you go to bed that night and you like wake up the next morning and you send out fresh orders to buy. And that can be really challenging as a mean reversion trader. So it is very directional.
I guess the one instance, of course, in which it helps is that if you have got a certain portion of your portfolio allocated to shorts, then that means that there is less allocated to longs. So it's another piece in the puzzle of reducing those bet sizes, so that each strategy is playing a smaller role and therefore has a smaller risk profile. One last question on mean reversion, I guess, before we talk about your entire portfolio solution and how you deal with this negative skew risk. 2022 was a tough year for mean reverters. So have you got any insights as to what exactly went wrong there for mean reversion trading?
Sure, I do, and I struggled myself during that year. And one of the things we all need to appreciate in this game is that we deal with the markets in a probabilistic manner. Okay, so when I say mean reversion is robust in the sense that if you entered one standard deviation and change it to 2, 3, you do fewer trades, but the win rates go up, the quality of the opportunity improves. That's probabilistic. It doesn't mean that's going to happen every year. 2022 was really unique, and it had me scratching my head. And what I uncovered after an extended amount of research is that the entire edge of mean reversion shifted to kind of zero point 0.2 standard deviations below the mean. So instead of having this idea, which kind of runs counter the thesis, because part of our thesis is it is that fear and emotion that creates these massive mispricings, which is largely true. And this is the trouble with financial markets in general. There's no absolutes in this game. You can have years where the way you rank is not the way you should rank. It reverses. And that's just an element of luck. And I think that may well have been the AI, or whatever forces we were encountering at that point where things just didn't sell off much. They reversed immediately. And that really forced me then to expand the way in which I capture mean reversion. So instead of starting your sort of exposure gathering one standard deviation down, I go, when a stock's at or below the mean, it's worthwhile starting to build a little bit of exposure, even though mostly that doesn't work. But we may well encounter 2022 at some future point, and that's going to help offset the losses elsewhere. And if you test that, you'll find that kind of holds through that period.
Awesome. All right. So we want these consistent compounding periods that mean reversion's working so well for us. We're making wonderful, consistent profits, but we want that tail risk protection. So the question is on everyone's lips is this possible and how? So talk to us a bit about what I think is your primary defense by introducing this non-correlated short-term trend following. Talk to us about
Sure.
how you developed that in conjunction, with full knowledge of what your mean reversion exposures were, and so why you developed these strategies, and and talk to us about, the development process, the thinking there.
So, I successfully traded mean reversion for, almost eight years. And so it's perfectly feasible as a standalone factor, provided you're operating in very short timeframes, you do all the things we're talking about here. But it really frustrated me that I had this sort of, these tail events that really kind of sidetracked us. And then my working hypothesis up to recently really was, 1987 is a really kind of a bad year for mean reversion. And so you kind of look at it and go, well, that's not going to repeat. We've become more intelligent. The regulators, they've implemented circuit breakers, and I've seen those unfold. And then, of course, we saw the Japanese crash recently. And, you kind of step back and go, wow, okay, so even with the circuit breakers, animal spirits, if there's enough fear running around, you couldn't kind. And that really kind of forced, okay, I need to reconsider this. I always knew from the very beginning that short-term trend following was going to be the perfect offset to mean reversion. They're mutually exclusive. They operate in different regimes, and they do their best performance in exactly counter environments. But to develop them was very difficult. So I spent a lot of time in mean reversion really working on tail risk, and feel like I came with some quite intelligent solutions. You can spend an awful amount of time on that, and there are ways to sort of mitigate it, but you'll never get away from it in full. And often what happens is when you're doing that is you're starting to increase the number of rules in your model, because you're now saying, hey, if this, and that happens, we need to reduce risk, etc. So you start to move away from robustness each time you do that. You also, I now know that markets can go Coral 1, so you've got a much smaller sample that you're testing on. And these are all things that really kind of annoyed me. And that's when I really started to turn my focus toward trend following. I started to, as I always had, my workflow was kind of start on the long end, try get something to work, see if you can invert it on the short side. Does that work? Okay, we've got something robust, etc. And the returns are really just not that great. You look at it and you're like, wow, I don't know if I can actually trade this. I'm sure I know my clients can't. And then I got thinking, let me step back a bit and reconsider my workflow. So instead of building these things in isolation, long, short, let's bring everything together. So let's build a portfolio and test it, the entire portfolio. So now we're talking about mean reversion, long and short, trend following, long and short. And the most incredible thing happened at that point. I started to see, tested results and equity curves that I hadn't seen before. And I got excited about that because now a lot of the risk inherent in mean reversion, I knew I wasn't layering rules and moving away from robustness. It was really being offset by another model. And the most interesting thing about this approach is I really could start to carve out all the filters and rules I previously had in mean reversion models to try sidestep these things and really kind of get to the core basics. And so if you test these models in isolation, they really aren't that exciting. It's the synergy between the two. And that's where I've moved to now is this. There's an incredible alpha if you're able to build a portfolio of mean reversion strategies and trend following strategies while considering the logic of either and their contribution to a portfolio, that's something worth spending your life on, because there's a lot you can do. And a good example is, we did a lot of modeling is, of course, 1987. And so when you test just your trend following, of course, in short end, we had a huge year there, 40, 50%. And that completely kind of mitigates the losses on mean reversion. That's true for most tail events. It's not a perfect hedge, nothing is, but largely it's a very effective way to hedge out mean reversion. And that's kind of where all my focus is today. And the private fund that I run deploys equal allocations to both those sources of return. But we're still faced with challenges, and especially on the execution front, which we can talk about.
Yeah, and and to really spell it out clearly, obviously, when your mean reversion models, long models, are trying to buy into a market that's tanking, and the market's tanking and hurting you, then the short trend following models are buying into that breakout and immediately starting to hedge. So it's kind of like a hedge that you're constantly putting on that's non-correlated with the mean reversion strategies.
That's exactly right. Yeah. So the trend following, of course, you're trying to latch onto a short-term trend, and your initial starting period are mutually exclusive, because in mean reversion, you kind of want a stretch condition, so price is trending in the short term, and that's where you take an opposing view. We don't want that with trend following. We want something that's kind of been consolidating and breaking out. And there's enough of that happening before any crisis to at least get some exposure on. And as that starts to unfold and speed up, the shorts on the trend following start to build an opposing exposure to trend following. So that offsets the risk. And if you're trading your mean reversion in short enough time frames, you may have little bounces on the way down where they're able to unwind while the shorts are, sort of ongoing in the trend following. And you can have overlaps on single counters where this works, but it's really more a cross-sectional thing. So it's the big moves where these things really tend to play out very well together.
So, give us an overview, just a high level of the key components here now for these breakout models or short-term trading models. So let's start with the consolidation that you mentioned. I guess typical to a lot of these kind of models, having some level of compression or consolidation is beneficial prior to jumping on board a big move. So is that one of the things you're looking for, and what are some of the other, I guess, items on your checklist?
Sure. So that's certainly a consideration one needs to implement. So I always like to invert things. So if you do it the other way around and try trend follow extreme moves, it just doesn't work. Markets tend to mean revert in the short term. So you need some consolidation. There are any number of ways you can measure that. You could use a contraction in Bollinger Bands. You could do recent highs and lows, etc. Something that's just signaling that the stock is not trending excessively in the short term. At that point, you don't know where the breakout's going to unfold. So often you'll find you're sending shorts and long breakout entries on that stock. And the breakouts typically it's not dissimilar to mean reversion in the sense that this edge doesn't persist very long. And that's intuitive. You have the stock, it's really kind of not doing anything, and then perhaps there's an earning release, which surprises to the downside or upside. So there's some sort of outside event that kind of triggers these moves. And then market participants, of course, respond to that. And so just simple breakouts will work. And then you want to trend follow in a very kind of typical way. You want to make sure you're not taking profits. You really want that positive skew. That's very important to offset with mean reversion. And then, as we discussed earlier with the mean reversion, you really need to make sure that you've got many entries and many exits and lots of different ways to enter. And you can take it a step further and even include different logic, which I think moves you toward a more full solution, because these things are quite sensitive to the stocks you hold, the prices, the changes. So you really want to do it in quite a diversified manner. What's interesting about the two, when you look at mean reversion, the edge is very robust in the sense that if you measure the stretch, the greater the stretch as we've spoken about, the better the quality of the opportunity. That doesn't necessarily hold in the trend following world. Compression works, but you can't keep going with it. The stock's more and more and more compressed, and the opportunity improves. So it's a lot more subtle. And because of that, one needs to then be a lot more diversified in how you pick up on the trend following.
So a lot of similar principles around the needing to diversify over a parameter set and run, I guess, distinct models side by side. Of course, playing in that shorter term space and looking for breakouts, there's potential for slippage. There's execution becomes super important. And I've always admired how you've built all of your own backtesting engine and all of your software, which has just been a phenomenal feat. So has that been critical for you to get the execution right in short-term breakouts?
I think you could almost argue, Simon, that half the edge lies in that. If you got really strong execution and trend following, that's half the game, probably even more already won, because it is so critical. You're positively skewed, and we know that we tend to whipsaw more than not. So most of these things are not going to work out, and the ones that do are very rapid in nature and can produce really outsized returns. So you can't afford to miss those. And to be honest, I don't have a full solution at this stage, but solutions exist. At the moment, I do have a custom execution engine and approach that only uses limit orders, and pretty pleased with the outcome. We kind of get 98% of the flow on limit orders. So there's literally no slippage and even positive slippage. For the remaining 2%, we convert to market. So that's something I'm working on at the moment. And that ensures then that we never miss a trade. It's going to be impossible, I think, to get away from slippage in its entirety without very sophisticated solutions. So, of course, you could, if you think of a long breakout and you have the skills and the facilities, you could easily join the best bid and adapt with it. And those types of algorithms do exist in some brokers. And that may well lead to a place, given that trend following tends to whipsaw more than not. If the bid goes down, you're getting positive slippage, you're moving with the bid. But also ensures that you'll follow the trend out where you might see positive. And the hope is you kind of net out over the long term. But I think if you've got enough diversification in there, right now I'm really kind of very happy with 80, 90% of the trend following exposure factor return. And we're doing better than that at this stage. Just something to offset mean reversion, So it's always better to have some of it than none of it.
There's so many difficulties in that space, in that short-term space. Have you managed to build the short and the long models in a fairly what's the word I'm looking for? Just equal and opposite manner, or are the short models different to the long models?
No, I'm glad you raised that, Simon, because in fact, I think so. Robustness is something we can talk about. It's really actually quite a nuanced, complicated thing. Early on in my life, I thought, it's just big data and regimes, lots of trade. And that really doesn't hold, actually. It's way more nuanced when it comes to trading. And one of the things I really like to see now, and it's kind of a requirement before I consider trading a model, is to test the long and invert the logic and test the short. And I know you have to discount for upward biases in the market and all those sorts of things, but you really want to see that work. And that's true for all the models I deploy. So the mean reversion logic is exactly the same on short and long side, just inverted. And that holds for the trend following as well. And one can't expect, of course, the shorts to do as well. There is upward drift, markets tend to rise. But where you are interested is, for example, in the Japanese sell-off, the US was hit. They had quite an extended holiday, so a lot of the trading moved from Japan onto the US markets, and we got caught in some of those. And the trend following models latched onto shorts to that period and completely offset the risk of mean reversion.
PJ, you talked about a 40-year backtest before. So do you find that it's especially important for the trend following strategies to have that long backtest? And I'm going to ask two questions at once. The second question is, why not just run the trend following? So talk to me about the need for the combined trend following plus mean reversion portfolio versus, what some of the issues might be with, say, just running the short-term breakouts. So, the combined and the length of the backtest.
Sure. So I think as a starting point, Simon, we need to understand that we've spoken about Leptokurtic distribution. So we know that price returns are not normally distributed. They resemble that, but they're not normally distributed. And because of that, we can't use normal statistics. So normal statistics, if you normally distribute it, so a purely random series, for example, flipping a coin, you're told that 30 is a smaller sample, should give you an idea, but when you get to 100 you get fairly decent sample. That doesn't hold in financial markets, and that's why I find it amusing that the first thing you'll be asked as a manager is what your Sharpe ratio is and your standard deviation. I agree they can be useful, but when you look at the failure rate of hedge funds, up at 75-80%, they all had Sharpe ratios at one point. And so what happened? Clearly they were hit with a tail or something. So that kind of immediately implies that this all falls by the wayside. You really need far more data than you might imagine. So 40 year, I talk about 40 year because that's kind of where our data ends. But I would love 100 years, 1,000 years. More is definitely better in this game. And so, yes, I think that's kind of the starting point for both strategies. I like to see more. And I can honestly say early on, I sort of worked on 10 and my thinking there was, well, most recent data is more relevant, and that may well be true. But I learned really a lot more by going back in 10-year increments. So I didn't always test all the way back 40 years. When it comes to trend following, these things are less persistent when compared with mean reversion. It's really the exception rather than the norm. And when you break these strategies out in isolation, you do find with the trend following that I've found it useful to have lengthier periods in the test to model the portfolios. And I think that's true for any quant. I think data and the length of time, the more is better for sure. And then coming back to your question, so why don't we just trade trend following? And it's as relevant to why don't we just trade long only mean reversion or short only mean reversion. The reason for that is if you just kind of flesh these out into isolation, the returns are not that impressive. Mean reversion is way more consistent for sure because it's the more prominent price behavior in the market. And trend following is not as much. So you can find on the short end with trend following, for example, you can have 2 or 3 years of really negative returns. And to sustain that in isolation is going to be difficult for you. And if you have investors, really difficult. So it's the combination. And it's, I think the holy grail here and where I'm sort of moving towards, if there is such a thing, it's the interplay between the two, because you'll find the periods that one of these contributing returns misbehave, there'll be contributions from the other opposing strategies. And that's really kind of critical. And so much so that, I've got to this place now where the models are way more simple, but not more simple than they need to be. So there's a lot of thought that goes into every single, component, but they're way more simple than any model I've traded before because they lean on one another to provide the risk offset. And actually, if you think about, let's just start with a long trend following trade, day T0, you've got a setup. Mean reversion cannot be interested. The logic's completely opposite, because it's consolidating. All right, so you go into day T1 and let's just imagine you put on your long trend following trade. Mean reversion is still not interested. Now let's imagine that the trend starts to work out the way you hope. And if it continues for a long enough time, eventually short mean reversion starts to get interested. And at that point, it may well put on a position. And you can think about it as a single stop, but it's really the cross-sectional nature of market movements where it becomes very, very powerful. So you then start to put on some mean reversion. Mean reversion you don't hold very long. So there's only a little bit of vol to the downside that allows you to capture a return, but mitigate the drawdown, like smooth out the return from the trend following. And the opposite holds with the mean reversion. So their contributions are incredible. They're intuitive, very difficult to do. But I think if you do it well at an extreme, I think you're getting very close to, we understand leptokurtic behavior, volatility clustering as a hallmark of financial markets. You're really building models now that capture every component of what we know to be true about financial markets.
Just something that came up for me today, actually, so I might ask it on the show. But when you're sending, these orders for non-correlated strategies, say they're in the same stock, say something does come up, like an entry for one and an exit for another. Are there any issues with crossing orders where the broker, like interactive brokers, will send me a message saying that, I can't send this order because it will cross a resting existing order. If I tried to send a market order to open and close the same stock at the same time, even though they might be, for me, different strategies and I'd like to run them independently. Have you had to deal with that?
That's an important consideration. I mean, you can deal with that on a more advanced level where you net internally, so then you don't pick up broker fees, which is obviously more ideal. I don't do that, but it's one way to solve that problem. I had the same problem when we used to execute through TradeStation. So then you end up creating sub accounts and you run all the strategies in isolation, so you don't have that problem. That's really not a great solution. Luckily, with the broker that we use, we don't have that problem at all. So they allow any number of orders to be sent to the market, provided you can almost you can label them. So you could be closing a position or opening, and they allow those to flow through. They won't allow, however, 2 market orders. That's very rare because I don't typically use those. But I could have an instance where we weren't filled on a long and a short, and because of that, the next day we send market, and that's quite easy to resolve. I mean, you could manually net that internally, or just let the one trade and then split seconds later release the other one. But that is something one needs to think about. And I have to say, when I step back from this game, every little working component, the complexities that go into each, it is a lot more work than one might imagine. I mean, you could have a full-time job just on execution, really getting down to good execution. And understanding your broker,
Yeah,
you know, is
100%.
another challenge.
Yeah, it's never-ending workload. So talk to us about your tech stack then. Like, I'm always so impressed that you've built your own C++ backtesting engine, the speed at which it runs, obviously your own execution engine, order management system, using your broker's API. So, you know, how did you do this, PJ? And
Well, I'm a sucker for
how
punishment,
important is it?
Simon.
Yeah, indeed.
Yeah,
It's
so
obviously super important.
yeah, thanks. So you know, I had the benefit before kids of a lot more time on my hands, and so
Mm-hmm.
I really just got quite deep into the coding side, and I do believe that if you really want to take this game seriously, that is, if you can't do it yourself, having someone that can, I think, is almost critical, because you end up in these retail platforms where you're really kind of canned, and it won't take long for you to start hitting your head on the ceiling and start hacking the system and building these kind of little code things around it. So I think that's really important. Nowadays, of course, you could go the Python route, which is way easier to learn. It's not as fast though, and I do, because I spend so much time on the C++, it becomes more naturally now, but the learning curve is really steep. So it's not something you would immediately move towards, given Python and all the cool libraries around that. But it's definitely been a sort of critical piece of infrastructure that's helped navigate the markets. The speed is important, and in fact, even today, I'm sort of outgrowing the infrastructure as it is. You know, I wrote a lot of this code almost 15 years ago, some of the core bits. So I'm in the process of migrating now with the advent of AI and parallel processing. These are all things we need to look at and consider. Even though I can run through thousands of permutations quickly compared to the likes of AmiBroke and others, it's still going to take time, you know. So I'm in the process of moving across to where you can use multiple cores, break the jobs up into little bits, and really speed things up. And I think it's frustrating. I'm sure you kind of share this, Simon, as an analyst. You have lots of ideas. I mean, we all have books and books of these ideas. And then testing them is just kind of this hurdle that slows you down. You know, you can't get to them. So you kind of, so that's, I think, it speeds up, you know, discovery of new ideas. So I think that's been really important. And then obviously managing the execution in a custom manner is really helpful too. You know, I've been able to deploy some sort of bespoke solutions. For example, we're probably sending 20 to 40,000 orders to the market each day. I can consolidate a lot of that
Gosh.
flow. So it gets consolidated. By the time it's consolidated, we're looking at 2,000 to 3,000 orders. So these are all things, you know, if you have the ability, you then can execute. Obviously, there are great efficiencies in terms of commissions and how, and that order flow, as I said, execution can be a full-time job, you know, can be analyzed further and how do you best execute in the market. But I do think in today's world, if you want to be in the data-driven sort of quant space, yeah, those will be critical skills down the line.
Right. So as we start to wrap up, PJ, I guess you touched on this before, but and maybe we've covered it, but I just I like the thinking around the emotions of trading and the behavioral biases that drive all of this. So, you know, is that still your thesis that these trading strategies work? Markets are something less than perfectly efficient, largely because of these human behavioral biases.
Absolutely, Simon. I mean, for me as a manager, it hasn't gone away. Losing money
Yeah,
and
this is
making
true.
money is, an inherently emotional experience. And I mean, there's some great, I mean, I can start with just an example from my own experience. You know, I've worked now with clients for almost 15 years running their money. Very few have really stuck for the long term. I'm now fortunate to have a core base of really strong believers that have been through the ups and downs with me. But in general, and given last year, unfortunately, I had one of my worst year really. I saw an exodus of clients, and if you run an analysis on that, just as a manager, you'll find your assets under management are almost perfectly correlated with performance. And so, these are some of the challenges you'll face as a manager, and some of the things I've had to embrace now is that you really need to look at your investors as really very sick individuals, emotionally sick. So this is another challenge one will face, continual education, holding hands, explaining, because it's extremely difficult. But I think the kind of poster child of them. There've been so many studies, but Peter Lynch has to be one
We
of them.
didn't mean that, by the way. It's just to all the clients out there. We still love you.
No, exactly.
But yeah,
we suffer the same symptoms. So I'm definitely a mere
indeed.
mortal in that regard. Um,
Yes.
But Peter Lynch is probably one of the best. He was considered probably the best mutual fund manager of all time. He ran a fund from 1977 to 1990, I think, where he generated net almost 30% a year. I think it was 29. So one would think all you had to do was sit and hold, and you're doubling your funds almost, every 2.5, 3 years. And they ran a study on that, and the average client lost money. I think that's just remarkable. And I've seen it in my
It
own,
is.
and I've seen it with myself too, and those
And that's
drawdowns.
obviously due to the times of when they've joined and when they've left.
Exactly right. And, you see good performance, they over allocate, and then they get a fright when it devalues and they deallocate. So some of the clients may have remained. And I can report stories on my end where, I've had clients literally get 25% over 5-year periods, but they're negative because when we suddenly had a very good year, they said, oh, this is really working. So let me put 10 times the amount in. And then you have a little marginal drawdown, and suddenly on a monetary basis, they're pulling everything out, and I've lost. And that client's unhappy despite the fact that the time weighted return is really a very good return. So I see it in clients, I see it in myself, and I think you only have to spend 5 minutes trading financial markets to appreciate how extreme emotion is. I don't believe that'll go away. And I think, as the saying goes, soldiers today face the same fears that warriors did over a century ago. I think it's really kind of hardwired into our psyche.
So, circling back to the philosophy, then there's logic involved. There is a thesis involved. There is data involved. There's a qualitative human factor in pulling all of that together. I'm curious whether you have some rules around, making robust strategies, such as, is out of sample data relevant to you or not anymore?
That's a good question. You can skin this cat many different ways, and I think I do lean on it to some extent, but largely given that the short frequencies with which I trade, I'm far more inclined to kind of go live with reduced allocations and test them. So my kind of solution, I think, firstly, if you look at the sort of out of sample idea, consider it. Okay, so you test, you leave 10 years at the edge, you test, you move forward in time and test on the 10 years that were out of sample and the performance is bad. Are you going to trade it? And the answer is no. So then your out of sample, testing is completely irrelevant. You're now in sample. And I think that happens a lot. I think I think clever ways to do it. One of the ways that I really kind of zero in on this is choose 100 liquid stocks or whatever, because the universe of equities is large, of course. Build your models, test them out, optimize them as best you can over the entire set of data, 40 years of data. And once you're comfortable that, you're kind of ticking the boxes on the robustness level, then go to the top 300, top 500, top 1,000, top 2,000. And if you're seeing, your performance validated, I think that's a great way to do it. You're exposing it to more stocks, more. And that's kind of what I lean on. And if I trickle down, then again, of course, you kind of have to revise things. You'll find as you get into the lower liquid stocks, those are good tests too, because they're much more risky. But if you do that in full, it generally leads to performance in other pockets of the market too.
But I guess you've also, in part of that, moved away from these exact setups and this overfitting. You talked about simplifying now, and you're really concentrating on the portfolio level, merging these offsetting strategies, constructing things in a sympathetic environment where logically things should work together. So it is, I guess, there's a lot more of a logic-based and experience-based approach that plays out now. Is that fair to say?
Yeah, I would say so, Simon. But I think you cannot perceive all the hidden risks associated with any model when you go live. And I think that's really a kind of critical point because, the trend following component of our portfolio is really only 2.5 years in. And I was dealt some big lessons last year, one of which was, if you're looking at recent volatility to position size, that's a silly way to do things because by nature, you're looking for consolidation. So volatility is contracting and you end up with disproportionately. And that was a hard lesson, but the test looked good. So I don't think you can actually build a model and then jump in with both feet and go, this thing's going to work. And I take it as far to say, Simon, if I had two people sitting in front of me and I had to allocate between them, one is a MIT graduate, PhD, and he's come to me with this kind of large language model optimized, 50-year backtest with 80% year returns, never a down month. And the other guy's, not a PhD. He's got 15 years of life performance, but he's really only done 8% a year. Where do you think I allocate? And it's the guy with life performance, hands down. The PhD is going back to graduate school, and they can be the most dangerous. They've optimized everything. So it's a challenging game, and I can honestly say that process, the feedback from the market, is the most invaluable you can get. People hate drawdown, they fear them, but the reality is those are the pockets that really contribute to robustness in your models, and that's where you can glean the most information. And as Nassim Taleb said, the predictor of manager success is how long they've been around multiplied by 2. So if you've just starting out, your life expectancy is 0, and that gradually kind of expands on. I really do believe in that.
So the importance, the role of backtests in building these strategies. Like once we have this experience of live trading versus the backtest. I mean the importance of the backtest, and certainly paying really specific regard to, like you said, the numbers or the statistics from a backtest. I mean, any one run, I guess the value of that is dramatically decreased, isn't it?
That's right. Yeah, I think going ahead in time, I don't think it's possible to build a model that is not slightly fit in some way. I think it's really difficult, for example, to trade a model that has a 50% drawdown when one tweak can halve that drawdown. Yeah, I think you're going to be very much inclined. You can try your best, we all do. But I do think that you're going to find in live that performance can wildly deviate from what you've seen in the past. And you need to build that into expectations. I think you need to build these things as best you can. Then you need to really give a lot of wiggle room, a large margin for them to move. And that's probably a sustainable way. And that kind of also ties into some of the lessons. If you are going to be a manager, sharing backtests is a real no-no. You can get yourself in a lot of trouble. You set clients' expectations incorrectly for everyone involved. So, and it's difficult, I understand. If you're starting out, you have to show something, but once you do get a bit of a track record, that's really where the focus needs to be, because you're just not going to completely replicate it as you move forward.
All right, PJ. Well, mate, I love that. I think we've talked through quite a bit. The way you've built that portfolio and merged all of those multiple strategies. It's a true multi-strat portfolio. Actually, that does make me just think of one last thing then. You've got this short-term, breakout trend following trading nicely added to a mean reversion portfolio. But have you had any interest in longer-term trend following or your traditional sort of rotational momentum strategies or factor-based strategies in stocks? Has anything else taken your fancy?
Yeah, I think, there have been times in the past where, we've kind of built, or I've built rather, momentum strategies, on the NASDAQ 100, and those sorts of things. Again, you're really leaning into, the thesis. And I believe there's absolutely solutions that can be had there and contribute. Why I sort of stray away from it, I think we'll focus more on the short term, and actually really would love to go intraday at some future point, is because you do get a lot more data. Markets are non-normal, so you need the data. And I think operating that space provides a better platform to build robust models. I can honestly say, given at least, over the years I've been profitable, but there's still been discrepancies. But models I've built on the longer time frames in the past have, really deviated. And it's difficult to respond. You need much more time before you kind of work out it's not working. So there are all sorts of reasons that I would always kind of be drawn to shorter term, high frequency trading rather than longer term. That's not to say I wouldn't possibly consider some sort of beta type underlying small exposure to contribute, but I think there are probably better ways to enhance performance. For example, we're just mean reversion trend following, but somewhere in between, there are edges there as well, which I think can diversify better than a momentum model.
Awesome. All right, PJ, what's next for you? Any interesting plans on the horizon?
Simon, I do sort of dream, in the past I ran Sutherland Research, and through that company, I really got to experience a lot of interaction with interesting people. And I love that component. As you probably appreciate, running your own funds or a fund can be quite lonely at times. It's nice to have that interaction. So I'm considering at this stage relaunching Sutherland Research at some point. You'll know as a analyst that you trade some ideas, but there are definitely a lot of other ideas that are good that you don't trade. And it would be a way to kind of get some research out there, start to interact with other traders. And I'm hoping at halfway through next year, thereabout, I'd be able to launch that. It'd be quite different in its nature, in the sense that I can pass along all the processing power we have to the end user, so they can backtest these ideas and ultimately buy the research or deploy them in a signals-based system. So we'll see how that goes. I often over-ambitious with my goals.
Yeah, no, I remember the last instance of that, and it was great. It harkens all the way back to the time when we met, I guess. But all right, PJ, look, thanks again. Really insightful chat. Is there anything else I've missed, or should we wrap it up?
No, thank you for having me, Simon. I know you've been on my tail for some time, so it's been a pleasure to be here. I'm glad I could contribute, and I think the only thing left is I look forward to seeing you in Indonesia at some point to surf, where we can discuss
absolutely
the likes of surfing and trading, such as patience and discipline and risk-taking out in the ocean.
Indeed, I've put it off long enough. Yes, exactly. It's funny because, surfing is a bit of a patience game, and you need to be a lot less patient over on those waves in Indo. There's a lot more of them.
Sure.
So, we've got to do that. Can't wait.
Great.
All right, PJ.
Look forward
Thanks
to
once again, mate. We'll talk soon.
My pleasure. Cheers, Simon. Stay well.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky, and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.